Hello, everybody, and welcome to the VRIC Media Channel. We are bringing the Vancouver Resource Investment Conference to you each and every week with our series of expert online panels. We have another great one lined up for you today. It's Chris Vermeulen of thetechnicaltraders.com and Dale Pinkert of TradeGate Hub. Gentlemen, it's great to have you both on the show.
Hey, thanks. Pleasure to be here.
Nice to see you again, Jesse, and great to meet you, Chris.
Yeah, same.
Excited to have this conversation. Now, we are going to be bringing up charts. We are going to be talking technical analysis. So for those who are listening to the podcast version of this program, there will be a link in the description to go to the YouTube video so you can see all the charts. I definitely recommend you do so. We're going to be discussing the US dollar, the broad market, gold, silver, energy, and a lot more. So let's get started with both of your outlook on the US dollar. Obviously, this is a topic of some contention, especially when it comes to gold and silver bugs. There's a narrative out there that although it's been showing strength, we are eventually going to see the dollar crumble and fiat currencies around the world follow suit. Obviously, that can be a bit hyperbolic, that type of language. So let's look at the charts and get both of your views. And Chris, I'll start with you on this one.
Sure. Yeah. Well, I know everybody's talking about the dollar collapsing. I actually think it's actually going to do fairly well for a little bit. I can share my chart here. And typically when we see chaos kind of hit the world or the market, we tend to see the US dollar do fairly well. During COVID, it initially had a little plunge and took off. But we saw back during the tech bubble, we saw the dollar do well. During the COVID crash, when we go back and not the COVID, the 2008 stock market crash, the dollar becomes a defensive play only for a short period of time. But then it falls out of favor. And, if we go back and we take a look at the big, the tech bubble here, I believe if we look at the big picture for where we are right now, I think the dollar is still going to become that favored kind of play, and we're going to see the dollar rally back to 115, potentially 120 or so. But I do think after that, which is going to be a fairly short-lived rally. I do think we're going to go into a multi-year sell-off, much actually like kind of after the tech bubble in 2000. We saw a multi-year sell-off, and I think that's going to send commodities, it's going to send precious metals through the roof, probably cryptos, because people aren't going to want to hold currencies. So I'm really bullish on the dollar here over the next, I don't know, 6, 12 months. We'll just have to see how the market unfolds. But I still think when everything hits the fan, we tend to see the US dollar index itself rally. So that's kind of my take. And of course, if it rallies and we see chaos hit the markets, there's going to be forced liquidation, panic selling among investors. Even people who love gold and silver, for example, are still going to be probably forced to liquidate, and we could see them pull back. They might hold their value fairly well compared to other assets, but I think the rising dollar, I think a weak economy coming and downturn in the stock market will pull on a lot of other assets, while the dollar, I think, can float higher.
Well, I do want to touch on gold and silver and the broad market in a moment as well. First, Dale, let's get your thoughts on the US dollar and how you see it performing up ahead.
Okay, this is going to be a very interesting show because I have a different view than
Yeah.
Chris.
That's why I
And
love having two guests on. Yeah.
okay, so looking at the U.S. dollar, I think last week was pretty pivotal. Let me just bring it in here. That we failed to take out the 107.40 high on this last rally at the 106.30. One trend line was already broken here, and the next one would be tripped under 104.5. I actually think that there's a chance it'll catch a lot of people flat-footed or wrong-footed, is that if it ever happens, and I don't think we're that far away, it could happen this week to start getting a correction in risk, that there won't be that type of safe haven buying in the dollar. Because when we were having sell-offs in April, the dollar really wasn't rallying. I think that, people have asked me in prior interviews, Dale, how could you be bearish a dollar with all the political instability in the UK? What happened in France? And my answer is there is no more political instability in the world, on the globe, than there is here in the US. You look at the European elections, the UK, they had an election. They didn't have anyone deny it or say it was rigged. They were able to pull it off, unlike what happened last year in the result of last election here. Same with France. They were able to have an election. There wasn't any violence. I'm not sure. And maybe we're even taking for granted that there's going to be an election in the U.S. We don't even know who's going to be the top of the ticket for the Democrats at this time. And, I'm aware of the milkshake theory. And, I think that the milkshake is going to evaporate under the heat of de-dollarization going forward. So I especially like the commodity currencies for some of the reasons that Chris mentioned, one of them being the short side of the Canadian dollar. Okay, so the Canadian dollar has really been in a distribution pattern for quite some time. If I pull up a longer term chart, you'll see it. And 136 is going to be a breakdown. So here's this is bigger levels down at 130, which I think that it's going to get there too. But just look at a daily, and you'll see that this 136 level has been challenged time and time again and time again. And it's almost like putting your shoulder into a door. And, the first time you go into the door, you can't break it open 2, 3 times, but we've had about 7 attempts at 136. The formation is called a descending triangle. That's with a descending line, flat bottom. You go right back to Edwards and McGee. It's a pretty classic reversal formation. So I like the commodity currencies. I think Aussie has been performing quite well. I'd buy any pullbacks to 67, 66 and a half. I actually think we could see an 80-cent Canadian. When I look at cable after the elections, look at what it's knocking at the door of right now. It's knocking at the door of a 200-week moving average. And the fact that it's been there before and came off and we're back there again tells me it's going to make a move through this moving average. So my take on the dollar is that we're going to take the second trend line out, and that comes in right around this 104.60 level, which really is pretty much in line with the daily moving average right here. So you have confluence with daily moving averages at 104.5 and that trend line, and taking that out gives me initially a 102 target. So I'm on the other side of the fence. It's Chris. And you know what? Chris will agree. It's important to know where you're wrong, because I could be, and I have been, and I'll continue to be wrong. And people ask me, well, how do you know you're wrong? My stops tell me I'm wrong. Right?
Yeah.
Okay. So it's not a subjective decision I have to make. So, I'm wrong over 106.50, because this would be a nice breakout to the upside. And then you'll get Chris's scenario for 110 or so. But I think we're at an inflection point here. And I'll just say one more thing. I think part of it is what's happening with yields. And, Powell may not bring down cut rates. But the market, to me, looks like, first of all, this was a failing rally from the 5% peak. Then we've had 2 lower highs here. And if we take out 420, oh, what a coincidence, another descending triangle. So, sometimes when you see formations, they seem to show up everywhere. And close under 420 is going to get you 370 on the 10-year. With a possible move towards 3%. And the only thing I could think of that's going to generate that is going to be risk off. So that's my take on the dollar. I'm a dollar bear unless the market can prove me wrong over 106.5. And I wouldn't be surprised by the next time you and I talk, Jesse, that we have a 90 handle on the Dixie.
Well, very
So
interesting thoughts from both of you when it comes to the dollar. Chris, is there anything you wanted to add to that?
Well, I think Dale touched on a really important thing. And I think as technical traders, like Dale and I are, who use charts and we use risk and position management. For example, you need to know when you're wrong. That's what stops do. And, we follow market trends. Right now, to me, the big picture, I'm looking at the dollar at a kind of a bigger picture here. I'm kind of bullish on it, not long the dollar so much. But a good example of what he talked about is like, I have been bearish on the equities markets for like 2-3 years. I keep thinking the top's about to come. The big picture keeps unfolding. We're getting closer to a major recession, to a lot of things now are really lining up, as we'll probably see through our talk here today, that points to a big reset, financial reset. And even though I've been wrong for 3 years, I'm still riding this market higher. We continue to ride it. So it doesn't matter what we think or feel. The key is we follow the charts. And until that market reverses and our trailing stops or our targets get hit, I mean, we just stay in that market. And that's the key where I think a lot of people get really messed up with stuff that Dale and I will talk about. Is they'll be like, well, you're super bearish on this and you're bullish on this. It doesn't actually mean that's the position, I'm in, for example. Like, I'm bearish on the equities market, but we are long. I'm just trying to, the analysis, I'm trying to paint the picture so people are mentally prepared that, hey, it looks like there's a major top coming. The dollar is about to have a huge break. It's been trading sideways for a couple of years. Whichever way it breaks, it's going to be great. I don't really care which way it breaks. When it does, though, it will be a trade for sure. So yeah, hopefully
well,
that
the reason I look at this dollar index as the potential both ways is, we had that high at 114 when the Fed embarked on its tightening right here. And all we've done through everything, and there's been, not much of a market sell-off, maybe a little bit in April. We've only been able to retrace 50% of this decline.
Mhm.
And the real breakdown in the dollar doesn't happen until we're under 100.
Yeah. Yeah.
So you could take two measured moves. You could go from 107, break down at 100, gives you 93, or you could go from over 114 to 100, and under 100 gives you 86.
Yeah.
And I think that will get your scenario, Chris, after this. And also think that a weak dollar will serve the purpose of people being so disgusted with the dollar and fearful of a dollar decline, they'll be more willing to accept the CBDC.
Quick break here. This episode is brought to you by West Red Lake Gold Mines. Now, if you know nothing about West Red Lake Gold Mines, let me tell you one thing. This company was founded on the back of a transaction where they purchased the Madsen mine in northwestern Ontario in an area called the Red Lake Gold District, which to date has produced around 30 million ounces of gold from some of the richest gold deposits in the world. Now, what they paid for this mine versus what they got has led legendary mining entrepreneur Frank Giustra to call this transaction the deal of the decade. And Bob Moriarty, founder of 321 Gold, was recently on my show calling West Red Lake Gold Mines one of the two most undervalued gold companies in Canada. If you're curious why these individuals are so excited about West Red Lake Gold Mines, hit the link below to learn more. Now back to the episode.
Let's talk about the S&P, the NASDAQ, the Dow Jones, and what both of you see happening in the broad market, because obviously we're seeing all of these indices continue to rally to all-time highs again and again. Even when we see a short breakdown, it appears to recover. And this feels like the classic Ben Graham, the market's way overvalued. For those who pay attention to history, this looks like a bubble, but maybe it's not. I'm wondering what both of you think. And Chris, I'll start with you.
Yeah, that's the big question. Is it a bubble? I do believe there's bubbles in some spots, like the tech kind of AI space, but from a really high level, I like to look. This is the weekly chart of the SPY, so the SP 500, and I always like to talk or refer to the stock market like the ocean. We're going to have periods where the tide is going up, where it lifts most stocks. We're going to have periods where the tide is going down. We don't really want to be into the equities space. And right now we're back into a rising tide. The chart still is very strong. It's still bullish in terms of the price action. But when you do peel back the layers and we look at the SP 500, there's no doubt we've got massive increased volatility over the last several years. AI really is doing, the Magnificent Seven is doing most of the heavy lifting. Where when we look at equal weighted, indexes or the Russell 2000, for example, and we look at these bigger pictures, especially the microcap stocks and even the Toronto venture capital, we've kind of put in what I believe is a major topping phase for the majority of stocks. Now, I think the big tech has dragged the SP 500 and the NASDAQ up to kind of camouflage what's going on behind the scenes. We're in this like consolidation phase. This could be a big breakdown. We might see small caps or the stock market have one more little push higher this summer for the next month or so, maybe. But I do believe we're going to see the markets go off a big cliff and sell off. And a lot of this, like when I look at that chart pattern, this is kind of goes back to Stan Weinstein's theory of four stages. I believe the stock market, when I look at what commodities like gold, oil stocks are doing, industrial stocks, small caps and micro caps, they're doing exactly what happens in the price formations of a stage 3. And once this runs out of steam, we go into a stage 4, which is a bear market. It's a financial reset, whatever it's going to be called, the next, I don't know, crisis of some sort. But that's kind of where I see us in the grand scheme of things. And we're going to touch on these other commodities here later. But typically this blue cycle here, the top of a stock market cycle, we tend to see gold do very well. Energy stocks are trading near all-time highs. And we've got industrial capital goods trading near all-time highs, very strong. All these things kind of happen at this late stage, and unemployment's starting to rise. All these things on the economic cycle. So we are like, to me, we're at the cusp here of how many more months are left before this, like, the equities market, pretty much the global equities market, goes into a type of major correction. And then the economy will kind of follow suit. So that's my take from 37,000 foot view.
Great. And Dale, what are your thoughts on the broad market? Do you differ with Chris once again on this issue, or are
No.
you kind of along the same path? All right, great. Yeah. Let us know what you're seeing.
There are a few things that are different over the past couple of weeks. For example, what was the most loved stock before 2 weeks ago was NVIDIA, right?
Mhm.
So, NVIDIA, for the first time, with several successive new contract highs in the Qs and in S&Ps, have not made new highs. Right now, it looks like a little bit of a bear flag to me. And even if you're bullish, I think we could see 100. If you're bearish, we're going to revisit lower levels. So that's one fly in the ointment. Canary in the coal mine is NVIDIA, which led all of this bullish enthusiasm for a couple of years, or at least a year, made new highs before the averages did. Now the averages are making new highs without NVIDIA. Something else that's different, and it's possible that it ekes out a new high, but normally through this bull market, when the S&P and the NASDAQ was making new highs, so was the Dow. Okay, so I guess we could ignore it. It's only the Dow Jones Industrials that they've changed the makeup of it several times. But, even if we made a new high, it would be a short to me, because one of my favorite formations is a 3 drive to a top and a drive to a bottom formation, where on your first high, you're confirmed by momentum. Your second high is a divergence for momentum. And your third high is your second momentum divergence. So that's something that people should be taking an eye on. I don't like the way the banks are acting, even the XLF, which looks a lot like the Dow, that perhaps we're going to get that third drive, is not making a new high. And definitely, if it was a year and a half ago when we had the Silicon Valley Bank blow up, right? And then everything's guaranteed. But just think about what kind of rally that we've had here in the market. And when you look at KRE, you had this big breakdown. This was SVB. And all we've been able to do is rally back to old support, new resistance. We're moving sideways. I suppose, like the Russell Chris is talking about, isn't doing much, that we could have another pop, but this is not a bullish chart to me. And if we start taking out 44, I think we're in for a retest of the lows, and we'll start hearing about more bank closures. And I think it could spread to money center banks. I think that's what's going to be behind a stock market sell-off. That's going to be some type of financial problem. And it doesn't even have to start here. I think it's going to start in Europe. And actually a stronger euro is not a benefit for Europe because they're a big exporting continent. It'll be good for US exporters, but not for Europe. So they have problems. When I look at this, if you're bearish, the market, of course, the bubbles are in AI, but the problems are in duration of bond portfolios and other derivatives at banks that could cause another confidence crisis.
Yeah, you bring up some really good points there, Dale. I think the fact that you use I call it 3 surges to a high or 3 surges to a low, same thing. I love that. It's one of the most powerful patterns, super strong.
Where did you learn it from, Chris? Where did you learn
it from? I don't know.
From?
I don't know if I ever learned it from anywhere. It's just something I always see, and I've followed it, and I talk about it with subscribers all the time when it sets up on a chart, because it is usually a really strong signal.
I learned it in the 70s from a trader named J.R. Hill. Okay, so, it's like Solomon says, nothing new under the sun. Elliott-ish, I found out, they call them ending diagonals. Okay. So I call them 3 drives to a top and bottom, but that's what I'm kind of known for. I like the number 3. It's a number of completion. 3 strikes, you're out.
Yep.
We're the 3rd planet from the sun. The 3rd time is the charm. So if you want to go spiritual, the Godhead is the Father, the Son, the Holy Spirit. So 3 is a number of completion to me.
Right. Yeah. Good. Yeah.
Very interesting.
But I have no copyright on it. I'm glad you use it.
Well, let's talk about gold and silver markets here. Obviously, very strong year for both metals, particularly gold reaching new all-time highs, now touching that $2,400 number. Silver reaching $30 once again. I haven't checked where we are today since trading started. I'm sure both of you know that better than me. But why don't we touch on both precious metals, gold and silver? And Chris, let's start with you. What are you seeing for both metals?
Sure. I mean, yeah, I think gold is a very strong chart pattern. So does silver. So do miners. Just looking at this chart, I mean, from just a general purpose, I mean, it's been a series of like a rally, a consolidation. We've had multiple rallies and consolidations. There's a whole bunch along the way, but this is a very, very nice looking chart pattern. I was kind of hoping we're actually going to see a little bit more selling down here, a little bit of a washout to spook some people out of gold, and we might still get that. But to me, the chart is still pointing to about 2650, 2750 in gold. It's up flirting near the highs. And this is kind of that defensive play. I think looking at the big picture, if we go back and take a look at how gold has kind of performed in the past, we kind of had a big super cycle start here back in early 2000. We went into a multi-year consolidation just before the 2008 market top. But leading into that, we saw money getting nervous, moving into the commodity space, into gold and silver as a defensive play. And then, of course, when we had 2008 correction, unfortunately, when there's a market reset, a financial crisis, it pulls some of the best assets down, including gold, pulled back about 34% before we went off to the big kind of massive multi-year run. I believe we started a super cycle in 2019. We've been in a multi-year consolidation. And right now we're seeing that run going into I think the next financial crisis. People are moving in because they're worried about the dollar. They're worried about falling stocks. They're worried about all kinds of stuff going on. And that's exactly kind of what we saw over here. So I believe there's a little more room for the precious metals to continue to act as that defensive play, people moving to a physical asset. I do think it'll probably pull back to some regard. How much? I'm not exactly sure, but I'm bullish on gold short term. I think potentially a year from now, it still might be back at this price if it pulls back with a market correction. But I kind of feel like we're having a big rinse and repeat of what's going on. I mean, I know every time it happens, it's a totally different scenario. But overall, I feel as though gold and silver are a very strong play here, short term. Long term, we're going to have a hiccup along the way, but I am very bullish on gold, 3,500 plus in due time. So I'm excited about the space. I really like it.
Do you think we could see silver back close to its all-time highs at any point in the next few years?
Oh yeah, I for sure. I mean, silver, I've got about 34 to 36 on the upside for silver over the next month or so. I think precious metals are kind of, to me, they're like the two, probably gold specifically, the lowest risk trade. I believe it's going to go higher with low volatility, no matter what the stock market does. I think even if the stock market goes sideways or starts to pull back, I think gold will still keep moving up. I think silver will as well. It's just a little more volatile. I don't think we're going to see, $50 silver till probably post some type of stage 4 financial reset. And then after that, I mean, some of my targets go up to about $82, $83 an ounce for silver. So I think there's, again, lots of upside in these. It's a little bit in the near future, but a lot when you look down the road a year, 2 or 3 or more.
Very interesting. Dale, your thoughts on the gold and silver markets?
Yes, I concur with Chris's assessment of gold and silver. I'm going to be a little bit more tactical in the gold. Let me just pull it up. We had, nice breakout out of a triangle last week. You could see that triangle. It's a little clearer on a daily. Okay, so we had this little breakout here. But all we really did was retrace this. I think the gold is overowned, and I'm tactically looking, especially if we negate the breakout. Some of your best trades are when breakouts are negated, and a lot of people will just get out. But the best trades are when a breakout's negated, because you have a lot of people on the other side of the market that aren't going to act if we take out 23.5 because they're still bullish. They'll have to get rinsed out. So I actually think that there's a chance we could see 2280 taken out if we negate this and trade between 2240 and 2200 in the weeks ahead. And it might happen if we get just a little bit of a sell-off in S&Ps and NASDAQ, which are fading as we speak. So I'm a buyer here. I don't know how Chris feels about the miners. I talk to a lot of gold guys that won't even touch the miners. They're afraid of land grabs. You have to do a lot of due diligence. It's important to know who the jockey is when you're trading miners, someone with a good track record for bringing out mines. But I look at Newmont up here, and I can't buy it with this kind of divergence. And I look at GDX, and it could be a right shoulder. We could still blow and have a 3 drive, but I can't get long up here. So I'm still looking for pullbacks. Even some of the silver stocks, I'm not impressed with SILJ, which is an ETF of the juniors. A bounce, but this even looks more like a head and shoulders. And I think tactically, if we get some type of decline in the S&Ps, that I'm going to be able to look at SILJ under 10, and I'd love to back up the truck on gold shares on a pullback to $30, which would be 61.8 back. It's not guaranteed. I'm not shorting it here, but I am trying to be patient for better entries and see if that plays out. And that's in the face of being bearish a dollar. So I have positions that tell me what to do technically, and yet I'm conflicted because normally a weaker dollar is going to be bullish for all commodities. But there are times when correlations break down. In the spring, the dollar was going up and gold was exploding. I think that gold is more overowned than euro. Who wants to own the euro? I mean, with what's going on over there, you don't hear anything bullish about Europe. So I don't think there's a lot of ownership. I'd rather be in under-owned currencies like along the Canadian Aussie than gold right now. But we get that pullback. That's the area I'd be looking to get long.
Yeah.
And
You
Chris,
bring
did
up
you
a
want to
really
add
good
any
point there,
thoughts
Dale.
about, yeah, go ahead.
Just about, and this is where a lot of people, I think, in the bond market got stuck. You've got one trade that's, saying the opposite of what you're thinking the dollar is going to do. But the reality is you got to follow price. And this is what so many people don't understand. They get hooked into the news. They get hooked in, bonds generally go up if the market's going down. They totally, they don't realize things change. Just because it happened in the past doesn't mean it's going to happen now. The best way, and that's why I think why we're probably both technical traders, is the chart tells us what to do. It doesn't matter. If it goes against what other markets, inter-market analysis is telling us, you still have to follow price. Price can buck the trends and break its norms. They do it all the time. So
correlations work till they stop.
Exactly. And if you were to look at like the price of gold and industrials and energy stocks and miners, in the early stages of when the stock market started to top back in 2008, the only ones that actually did really well were the miners struggled. They held their ground. They moved up like something like 2 or 3% between a specific window, where gold and silver rallied many percentage, 6, 7, 8%. Because they're not connected to that stock market. So your point here of these looking like potential head and shoulders patterns, even if gold and silver do move up, I think the miners are going to have a headwind, because if the stock market does pull back, gold stocks are stuck in the stock market. When that tide's going down, it naturally wants to pull everything else down in it. And that's why I like physical gold or a gold ETF that's pure physical, simply because it's kind of disconnected at some point. And it has shown in the past that it can keep floating higher while the rest of the precious metal miner space is going down with the equities market.
It's been happening for years.
Yeah.
Yeah.
Well, let's move on to the energy space, oil and gas. This is a sector that I'm personally overweight on. My time horizon is long. It's 3 to 5 years. Tell me if I'm right or why I'm wrong. Chris, we'll start with you.
Sure. Yeah. Let me grab my chart here. I'm not overly excited about the energy space, just as myself. I mean, let's just zoom out, take a look at the big picture here. We're kind of in a few different phases. Typically, or not typically, but in the past, we've seen back in 2007, 2008, we usually see energy do fairly well. Energy stocks have done well. They have a correction. It's hard to see here because they have the chart squished so much, but there was a big pause in here on the monthly chart. And this is for crude oil. If we kind of zoom in, definitely hard to see. This one happened in a very waterfall sell-off, but we had a huge move up in energy stocks, had a big pullback, consolidated, and then we went into the stage for decline in the equities markets. If we were to go and take a look at what's going on here with the big picture of oil right now, and this is just really high level basic analysis. Dale's definitely more into the finer granular detail, but we've seen that big move up in oil, and now we're in this consolidation phase. We do have, when we look at energy stocks for this big picture, energy stocks are pushing up near all-time highs. They've had a little pullback over the last couple of months, but they are flirting with all-time highs. We saw this happen as well just before the stock market went off a cliff. We've got multiple surges and pokes here in price action, which is generally not the best sign. It's definitely very volatile. I do feel like we still might have a little bit of a push in a rally in the energy space and one more final push. But overall, I do see energy and oil stocks going to be under quite a bit of pressure, which isn't good for your positions at this point. But I mean, right now they're holding their ground. Is this a bear flag? Is this a base? To me, this is actually very similar to the dollar chart. Just this section,
Yeah.
it's trading sideways. Like, where's it going to go? Whichever way it breaks is going to be a great opportunity, and it'll definitely create some movements in the energy stocks for sure.
And looking out further, do you think after a financial reset, after a stage 4 market decline, do you think that oil could be one of the assets that then recovers and goes on to be bullish in your mind? What's your thoughts when we kind of zoom out to the longer term picture?
Yeah, I think we could see I think we could see oil down in the 50s, 40s very easily. People are like, that's way too cheap. There's no way it's going down there. But I mean, if you look back, the last 20 years, we've hit this level many, many times. Like who would have thought we could have gone negative? I believe there's a lot of downside in oil. I think we're going to go into a recession. Things are going to tighten up. The markets move super fast. Long term, I mean, I think it's still going to be a great opportunity. I think oil will go back up and it'll probably go back into the 80s and 100 zone, in the future again. Elon Musk was talking about how many vehicles there are in the world and how long it would take for the EV market to get there. I think he said there's like 25 or 26 billion vehicles. He says even if they could produce a billion EVs a year, which is like crazy, he's like, it's going to take 25 years just to even catch up. So, I mean, oil, it's going to be here for a long time. It's still going to be used. And really, the price charts are just the ebbs and flows of people's sentiment and economic waves of strength and weakness. And sometimes they work together and create extreme moves. Sometimes they get stuck kind of with mixed signals, I think. And that's why we get this consolidation. But I do think oil will probably be in the 80s and $100 mark in the future. It's just short-term weakness maybe over the next year or two, depending how long this kind of financial reset takes to happen, and then how long it drags out. Is it going to be a multi-year bear market? Is it going to be a waterfall sell-off that happens in like 8 months and everything resets much quicker? It really just kind of, to me, is going to depend on how things kind of go into this sell-off going forward.
Great analysis there. Dale, your thoughts on the oil and gas sector?
I love Chris's chart on that. Can you put it back up there, Chris?
Sure. Yeah.
Your oil chart, it has some nice lines. So the way I feel about oil is Chris has definitely defined that we're in a sideways trading range after a big decline, which is neutral, but that was pretty impulsive to the downside. And I could definitely agree with what could happen target-wise. But I'm a little more concerned about geo risk right now, so I won't play the short side of oil right now because I don't believe what happened between Israel and Iran is going to be a one-off, and that the fact that Iran's president wants to have a dialogue with the U.S. We've been here before. So just any problem in the Gulf or the Strait of Hormuz can just generate a tremendous move to the upside. And something to keep in mind that almost every recession in the U.S. in the modern era has been caused by an oil shock. And, I don't think we could say that with the invasion of Ukraine. Didn't stay up there that long. But if we start seeing oil back over 100, 110, which it could do without making new highs, is still going to pressure an overburdened consumer that, has to make decisions between medicine and utilities and rent and the basic necessities. I feel that when I look at this economy, it reminds me of it's the best of times and the worst of times. That the income disparity that people have been talking about for decades is so extreme right now. And geopolitically, with what's going to happen in the Middle East, not knowing about leadership from the U.S., and knowing that Netanyahu has to stay in office not to get prosecuted, makes me a little leery about trying the short side of oil. If I was to trade it, be from the long side with stops underneath that line. But you know what? You don't have to be in everything. Trade your highest conviction trades. There's nothing wrong with saying, I don't know. In fact, when I was younger, I would pretend I knew because I felt silly not having an answer or a view or an opinion. And it's actually wisdom to say, I don't know. And it's actually cathartic to say I was wrong because everyone was. So crude as an I don't know, I have, some trader intuition that tells me not to be short though.
Yeah, that's
Very
how I
interesting.
feel. And Dale brings up, I think one of the most powerful kind of points that I think a lot of people get stuck in is there's a lot of misconceptions, I think, among traders and investors, and they think that they always need to be in trades. They need to be diversified and be in all kinds of stuff. And they always think they need to be in fast moving stuff. And I kind of deviate, far away from that. And as I said, I'm not that interested in oil. To me, it's a tough play here. Lots going on. And sometimes sitting in cash or playing one of those most boring, slowest, assets that, a lot of people move into stuff that they don't really know. It's moving fast. It's like, I like to think of the stock market or fast moving commodities or stocks like one of those, those blue bug zapper lights. It attracts traders because it's moving fast. It's in the news, but they usually get fried in the end. And I like to sit in the markets, wait for some type of wave of something that I know. I understand that asset. I know its volatility. I know how it moves. I know how it's related to other assets. And then you move into something that you understand. You don't just jump into something because everyone else is. And that's where a lot of people get wrong, is they think they need to be in it, or they don't accept that they don't know enough to to avoid it.
Yeah,
Cash
great
is
words of wisdom from both of you.
cash is a position too. And
Yes.
in the markets nowadays, you don't see that happen. It's rotation. They'll
Yeah.
sell something and buy something else because they're afraid of getting a red card. If you're a soccer fan, get thrown out of the game with a red card if you go to cash. But cash gives you the ability to deploy.
Yeah.
If it's all committed, then you have to make a decision of what you're going to get out of to deploy for another opportunity. There's nothing wrong with cash.
No.
Yeah,
especially
Canada,
that's a great point of view.
Yeah. And Canada's going to whoop Argentina in soccer on Tuesday night.
I'm looking forward to seeing the game, Chris. Yeah, I'm a converted fan.
Yeah.
I thought, you can't. Football is, shoulder pads and helmets and touchdown passes, but
Yeah.
this is pretty good football too. Oh, I wanted to ask you, with my bearishness in Canada, Canada's economy is having a lot of trouble, isn't it? With real estate, because they don't have 30-year mortgages there. Is
Yeah.
that correct?
Yep. Yeah. So
Okay.
the big problem here is everyone has to renew not everyone, the majority of people either sign on for a 1 year, 3 year, 5 year. That's the majority of mortgages.
Okay.
And so this year is year 3. And in my town, we had anywhere from about 80 homes for sale in our town a couple of years ago or a year ago. Now there's almost 600 because people
Wow.
can't afford their mortgages. And I had my truck service. This was almost a year ago. Oh, no, it's just before Christmas, I think, actually. He asked me, he's like, do you want to buy my house? I'm like, not really. Because to me, everything's overpriced and all that stuff. I'm like, why? He's like, my mortgage comes up for renewal. I was paying I don't know what it was, 1.3 or 1.4%. He's like, it's coming up at 5.9%. He goes, I can't afford the mortgage. We bought a house that was a high value, but the low rate made it easy. And that's where everybody is right now. Homes aren't moving very fast. Prices keep getting reduced. This is just the wave of the 3 years. The 5 year is the most popular. So in 2 years from now, or a year and a half from now, Canada real estate is going to be an incredible opportunity for anyone who has saved their cash, been able to, move aside. You're going to have rental, the multifamilies, you duplexes, triplexes, workshops, warehousing, storefronts. I mean, it's going to be if you're an investor with money, you're a kid in a candy store, but it's 2 more years out before the bloodbath really kicks in. So there's opportunity in it, but it's going to be painful for the majority.
I hear it's so much more painful up there because in the US, you could walk away without many consequences. Of course, you'll have a foreclosure on your credit report, but I was told in Canada, you're still liable for the mortgage debt, that your wages could be garnished, any other
Yeah.
assets that you have could be attached. It's
Yeah.
almost like a financial death sentence if you walk away from your house in Canada. Is that
Yeah, you
true?
do. Yeah, you'd have to file for complete bankruptcy to reset your slate, right? Have a
Okay.
fresh new everything. But then you're out of commission for 7 years. You can't get
Yeah.
credit, you can't do anything. So it really puts a
It's
damper on
tough.
things.
Yeah.
Well, let's finish
Okay.
on where you're both seeing opportunity in the market. What is your most highest conviction trade right now? And you could even say cash if that's what you think. And which sectors would you be completely avoiding at the moment? Chris, I'll start with you.
Yeah, I mean, I kind of already actually said what I believe. I actually believe physical gold is the best play right now. I think it'll do well for a couple of months, a few months. I do think it'll run into some headwinds late this year or next year. So it is more so a trade. That is, to me, I like low volatility stuff. If something moves really fast, I don't even think about trading it or investing in it. I don't want to have a whole bunch of tiny positions that are all volatile. I'd rather move into a couple assets that I know very well that are slow moving, like a tide, right? And I like index, I like ETFs, I like to play bigger moving things. So to me, physical gold, GLD is a great play. I think SLV is a good play, more volatile. So it's, a smaller portion if you can't handle volatility. Those to me are the ultimate play. In a perfect world, I'd buy gold, for like 2 or 3 months. And then I actually might shift to the US dollar index because I think the stock market will be falling at that point. And I think the dollar, if it breaks to the upside, I think it's going to have a tremendous run. It's going to be a nice low volatility play. We play US dollar in 2022. Stock market, the buy and hold portfolio fell like 24-25%. The US dollar, UUP, moved up 18% with the biggest pullback less than 4%. I mean, talk about a comfortable, easy way. I love currencies. I love the dollar index. To me, it moves consistent and slow. You just need to wait for it to break out of like a range that it's in now to start a trend. So I think it's gold and the dollar and then inverse ETFs on the indexes. And then the world will reset and then back into a bull market phase. That would be the dream kind of unfold.
Very fascinating. Dale, what is your highest conviction trades right now, and maybe areas of the market that you'd be avoiding as well?
Okay. Well, I have a lot of conviction about that 420 level being taken out in the 10-year yield. So lower yields and TLT will probably get a ride out of that. I'd love to see a pullback in gold for a buy in the miners and the GDX 30 at 30 or 31. Today I started buying VIX calls out to December, and I own SQQ calls. So that's how I'm positioned.
Dale, how long are you looking out for those plays to
December.
Okay, gotcha. Yeah.
Yeah, if you're trading options, buy time and don't be a hero with your strike prices. And if you want a money management tool for options, I risk half the premium I pay.
Right. Okay.
So that's my decision time to get out or be willing to see him go to zero. And I've had a few of those where I could use it for wallpaper.
Well, gentlemen, this has been
a
fantastic conversation. Before I do let both of you go, Chris, tell us about the technicaltraders.com, what it is you do there.
Yeah, at the Technical Traders, I share my analysis. So I've built trading strategies around trading ETFs only. I focus on the strategies for trading and investing my own capital. I share it with others. So everything that I put on there with my asset reinvesting strategy, which is we focus on more or less one asset class at a time with an ETF. You just copy what I do. And I do a morning video where I walk through the charts every morning at more very granular level, more like Dale. And what's flowing, what's moving, how it'll affect our positions, be mentally prepared for when the Fed comes out or these, whatever's unfolding. And I also provide auto trading. So if somebody doesn't want to learn or do anything, it can automatically execute these trades in their account, in their self-directed account for them. And I'm focusing on 5 to 12 waves that roll through the market every year. So as I always go back to the markets like the ocean, when the tide is going up, or it doesn't actually matter which way the tide is going, I'm like a surfer on the horizon waiting for a set of waves to roll through the market. And if we see a nice set of waves rolling through, we pick the asset that we know that fits our criteria, and then we'll hop on that wave. And there's 5 to 12 of these every year. And the nice thing about waiting for those big waves to roll through is we know they have power and momentum. And then once they start to lose momentum, we can see that as well. So we can start to take profits, move our stops up, and start, moving back to cash, because we wait in a cash position, and just earn daily interest and monthly dividends until another wave comes. So we're very passive. The stock market is super complex. It's funny, so many sophisticated individuals and entrepreneurs get into the markets thinking they're going to crush it. And entrepreneurs are very good at making things happen. But when it comes to the markets, you can't make stuff happen. You have to sit back and let the trades come to you. So it's very difficult for people to come in and wait for stuff. Like people always say, my strategy is like watching paint dry. I'm like, I know, we just have to let them come to us. We can't just jump in because we want to make a trade. And that's where people overtrade. It's not about being in trades to make money. It's about making good trades. So that's what I focus on.
Great. Well, I'll put a link in the description below to the technicaltraders.com. Dale, tell us about TradeGate Hub and what it is you do there, where people can find it.
TradeGateHub.com is a website. We also have a room that's free for people where I post my ideas. I do videos. And besides making trade calls and recommendations, I teach my methods, 3 drives. I teach about RSI, the difference between confirming action and diverging. And the shirt I'm wearing today isn't a normal flag shirt. It's America in Distress. And I also think what Chris said, the surfing analogy is perfect, because you know what? And I've tried it, but I wasn't that great at surfing. I would pearl. I'd catch the peak of the wave and then there'd be air underneath me. I didn't try till I was 40. But great surfers don't try and catch every wave. They too wait for the right setup. Great analogy, surfing.
Awesome. Well, I'll put a link to tradegatehub.com in the description as well. Gentlemen, it's been a blast. Very much enjoyed our conversation, and thank you for coming on today.
Hey, thanks, Jesse. Pleasure. Take care.
Yeah, Jesse. Maybe we'll see 90 in the Dixie. And Chris, it was great listening to you. I learned some things from you today, and very nice to meet you. Maybe we could do something
Sounds great, Dale. Thanks.
down the road.